After a lack of volatility over the last few months, volatility finally seems to have picked up since the end of April, amid renewed turmoil in Europe. Joining me on the phone is James Hughes, Chief Market Analyst at Alpari UK. James, hi. Now, central banks around the world have been indirectly calming the currency market through asset purchase programs, as well as currency floors put in place by central banks of safe haven currencies. We've got examples like the Swiss franc. Of course, they're contributing to lower volatility between major currency pairs. In some ways, James, are they doing more harm than good?
Well, I think any intervention into a currency is not a positive thing. I think when central banks or whoever it may be need to intervene in economies or in currencies, I think what we'd all most like, of course, is for these economies and currencies to run on their own without any type of intervention, and let economies have a natural progression in positive and negative ways. But of course, we can't have that at the moment, the way the world is. And I think it's the overall performance of the global economy which is making central banks so nervous. And I think that's what it is. It's more a nervous reaction than anything, because of course no one wants to see the values of their currency dip or move to the levels that they're protecting against. So I think it does do a little bit more harm than good, to be perfectly honest. But I mean, what we want in this market, as you say, is volatility. And whenever an announcement like that comes out, you do tend to get that volatility. But I think what we all want is almost a free market, which is completely free of any interference.
Surely the ongoing crises in the Eurozone and Greece in particular leaves the euro at risk across the board. Do you see the broader trend for euro weakness to remain intact?
Well, I think so, but I think if you look at the euro for the last 2 years or so, although we've seen losses, everyone's been quite surprised at how well it's managed to stay positive, because the falls haven't necessarily been as aggressive as many people thought. And I think a main reason for that is that when we look at this crisis, everyone seems to think that the final outcome, the worst case scenario, is the fact that we maybe won't have a euro at the very, very worst case scenario. But just before that, you've got the case that countries will start to leave, and those countries that will leave will be the weaker economies, left with stronger Germany. And I think you're only looking at Germany as the strong one at the moment, but Germany being the major player in there. So I think that's why it holds up. But I think, of course, with what's going on now, and we've had more developments in the last couple of weeks, of course, I think the likelihood of Greece going out of the Eurozone now is pretty likely, seeing as the country can barely form a government, let alone be part of the monetary union. So I think there is a degree of downside that is coming. We've seen that in the last couple of weeks or so. It just depends how much of that is already written in. I don't think it is as of yet, but I think as developments go on, of course, we've got to wait till middle of June until we get the election. So there's quite a lot of news that still has to come out. We've got new governments in France. We've got a lot of new and unanswered questions in the Eurozone at the moment. And I think that uncertainty, it's an old cliche, but the markets hate uncertainty, and that tends to drive them down, and that's what we've got at the moment.
Looking at the euro against the US dollar, for example, for much of the year this pair has traded in a tight range. It's taking a while to get moving, but what's the next target for euro dollar? Is it now primed for a short covering rally?
I think the euro dollar is interesting because I think in the US governments and traders in the US are trying to ignore what goes on in the Eurozone. And what we've had is quite a strange phenomenon, really, is the fact that the markets have become numb to anything Eurozone. Now, that isn't the case throughout May, of course. May has been a drastically bad month for the euro. But I think if you look almost from the start of this year, from almost middle of January to the end of April, we've really treaded water within the euro, and any sort of announcement about the Eurozone, whether it be positive or negative news, has almost gone unnoticed in the euro because the markets are becoming numb to it. And the issue that we have in the US as well is the fact that they seem to be dealing with their own problems and dealing with them quite well. So I think you're moving into a more positive time in the US. While in the Eurozone, you're getting a little bit, we're getting a little bit more uncertain yet again, and these tend to come around every sort of 6 months or so. So I think they really are playing off against each other. I wouldn't be surprised to see the negativity from May covered by some sort of rally once we settle down and we see exactly what's going on with Greece, maybe once a government's in place there, and once the French government settles down. So I think there would be a degree of calm after that, with the markets rallying a little bit higher. But I don't see that continuing. But I see these choppy markets due to the uncertainty. I just see a choppy euro for a long while yet.
So James, where does that leave us for the rest of 2012? Should the markets be prepared for greater volatility and perhaps more choppiness?
I mean, I think so. I think almost the calmness of the last quarter really has been down to the fact that 2011 saw, again, unbelievable volatility. So I think the fact that you almost get at some calm quarters or some calm months after such big moves is not a surprise. We can't have volatility as big as it is for as long as we have seen it. I don't see a huge decline in the in many of the currencies or many of the major markets. I mean, the euro is at a crossroad where it hasn't been at the moment. I mean, we are the closest we've been to a country leaving the eurozone, and no matter what we've said about Greece in the past over the last couple of years, we've never been this close to them actually pulling out of it, and that is the unknown. That's the great unknown at the moment. So why we don't know, we're going to get volatility where the markets spike around all over the place. Once it actually happens, that is the unknown territory. We don't know how we're going to react. We don't know how Greece will react. We don't know how the eurozone will react. And it's almost going to be a matter of fingers crossed and hope for the best, I think.
James, thank you very much again for speaking to me. Now, coming up on DukascopyTV is a press review with my colleague Monica Gibson and the week ahead for markets. For now, though, goodbye.